This question tests your understanding of the advantages and limitations of historical cost accounting, HCA. Historical cost accounting records assets and liabilities at their original transaction price and generally does not adjust them for subsequent changes in market value. The key phrase is not an advantage, meaning you must identify the statement that is false as an advantage of HCA. When answering this type of question, remember the commonly accepted benefits of historical cost accounting. Objectivity and reliability. Amounts are based on actual transactions. Verifiability. Figures can be supported by invoices, contracts, and receipts. Simplicity and consistency. Calculations are straightforward. Reduced subjectivity. Fewer estimates and valuations are required compared with current value accounting. However, a major weakness of historical cost accounting is that it can become misleading during periods of inflation because assets and expenses may be understated relative to current economic values. Amounts of transactions are reliable and can be verified. This is an advantage. Historical costs are based on actual transactions and supporting documentation, making them highly reliable and auditable. B. Amounts in the statement of financial position can be matched to amounts in the statement of cash flows. This is generally an advantage. Historical cost figures often have a clear link to actual cash transactions, making reconciliation easier. C. It avoids the overstatement of profit, which can arise during periods of inflation. This is the correct answer. Historical cost accounting does not avoid profit overstatement during inflation. In fact, it can contribute to it. Depreciation and cost of sales are based on old, lower historical costs, while revenues are earned at current higher prices. This can artificially inflate reported profits. D. It provides fewer opportunities for creative accounting than systems of current value accounting. This is an advantage. Current value accounting requires more estimates and valuations, creating greater scope for managerial judgment and manipulation. Correct answer. C. It avoids the overstatement of profit, which can arise during periods of inflation. Historical cost accounting may actually overstate profit during inflationary periods, making this statement the one that is not an advantage of historical cost accounting. This question tests your understanding of the effects of inflation on accounting profits and the consequences of reporting profits using historical cost accounting. During periods of inflation, assets purchased in the past are recorded at old, lower costs. Depreciation and cost of sales are therefore understated compared with current replacement costs. As a result, reported profits can be artificially overstated, even though the business may not be generating greater real economic wealth. The key examination technique is to identify what consequences logically follow from an overstatement of profit. If stakeholders believe profits are higher than they really are, they may make decisions based on incorrect information. The question asks for the option that is not a likely consequence. Therefore, look for the answer that moves in the opposite direction from what inflated profits would normally cause. A. Higher wage demands from employees. Likely consequence. Employees and trade unions often use company profitability as a basis for wage negotiations. If reported profits appear unusually high, employees may demand higher salaries or bonuses. B. Higher tax bills. Likely consequence. Corporate taxes are generally based on taxable profits. If profits are overstated, taxable income may also be higher, resulting in increased tax liabilities. C. Reduced dividends to shareholders. Not a likely consequence. Correct answer. If profits are overstated, directors may believe more distributable profits are available. This would normally encourage higher, not lower, dividend payments. Therefore, reduced dividends are not a logical consequence of overstated profits. D. Overstated EPS. Likely consequence. Earnings per share (EPS) is calculated using profit attributable to shareholders. If profit is overstated, EPS will also be overstated, potentially misleading investors about company performance. Correct answer: C. Reduced dividends to shareholders. Exam tip: when inflation causes profits to be overstated, the usual effects are higher apparent profitability, higher taxes, higher dividend expectations / payments, higher EPS, greater wage pressure from employees. Therefore, any option suggesting a reduction in dividends is inconsistent with the normal consequences of overstated profits and is the correct answer. This question tests your understanding of capital maintenance concepts in accounting, specifically the distinction between financial capital maintenance and physical capital maintenance. The question states that physical capital maintenance defines profit as the increase in the physical productive capacity of a business during a period. In other words, a company only earns profit after it has maintained its ability to produce the same quantity of goods and services as at the beginning of the period. The key issue is identifying which accounting system measures assets and profits in a way that preserves the business's operating capability. During periods of changing prices, historical costs may understate the amount required to replace assets, leading to overstated profits. Physical capital maintenance, therefore, requires assets to be valued based on their current replacement cost rather than their original purchase cost. Students should remember, financial capital maintenance focuses on maintaining the monetary value of shareholders' investment. Physical capital maintenance focuses on maintaining the business's productive capacity. The accounting method associated with physical capital maintenance is current cost accounting, CCA. A. Current cost accounting. Correct. Current cost accounting values assets at their current replacement cost. This ensures sufficient resources are retained to replace operating assets and maintain the business's productive capacity. Therefore, it directly supports the concept of physical capital maintenance. B. Historical cost accounting. Historical cost accounting records assets at their original purchase price. It ignores changes in replacement costs and does not preserve productive capacity during inflation. C. Current value accounting. Current value accounting focuses on the current market value of assets rather than maintaining operating capability. It is not specifically linked to physical capital maintenance. D. Current purchasing power accounting. Current purchasing power accounting adjusts figures for general inflation to maintain the purchasing power of financial capital. It relates to financial capital maintenance, not physical capital maintenance. Correct answer: current cost accounting. Exam tip: remember the association. Physical capital maintenance, current cost accounting, CCA, financial capital maintenance, historical cost accounting, or current purchasing power accounting, CPPA, depending on the measurement basis used.